Do you want to know how investors go from one property to an entire portfolio? Because when you talk to most real estate investors, they'll go like,
My money is tied up in that property.
sounds familiar, right? Imagine not having to lock your cash in each and every deal. It's about recycling your money. The least money in, most money out, repeat. It's like putting your real estate investing on autopilot. It's a method called BRRRR. Buy, rehab, rent, refinance, repeat. We fund investors that do exactly that each day and every day. If you want to learn how to do that, this video is for you. If you appreciate this type of content, or if you think that it can help other entrepreneurs, please subscribe to our channel. Thank you. First, what is BRRRR? Well, it's a strategy to recycle your cash. First, you buy a distressed property below market. Second, it's the rehab to increase its value. Third, you rent it out so that the property can start making income. Fourth, you refinance it so that you can pull your cash out, and also so that you can have a long-term mortgage that is as cheap as possible, let's say 30 years, so that you can make the most money out of renting out that property, right? And then fifth, you repeat because you already pulled out your cash. So now it's time to take this cash and put it in your other property. So this is how you go from one property to another again, and to a whole portfolio. Now, there are two ways to do a BRRRR, okay? Now, if you do a regular mortgage, let's say first a conventional mortgage, right? A bank loan. So in general, with a bank loan, you have to put 25% down. On top of that, when it comes to the rehab is on you. It's all your cost. So it's not only 25% down plus the entire cost of the rehab. Whereas option two, you enter with a rehab loan. With a rehab loan, what they call a fix and flip loan, you only have to put between 10 to 20% down. On top of that, the rehab is 100% finance. So you have to put zero money in the rehab. Example, let's illustrate. Say, for instance, that you find a big, beautiful home. Underpriced, right? That you need to do some rehab. And the purchase price is $200,000. And the rehab is $50,000. So your total cost would be $250,000. If you go the first route, right, with a regular mortgage, with a 25% down, that would be $50,000 down, right? Plus the rehab cost would be on you, meaning that you would have to pay $50,000 to rehab the property. Your total cash in out of pocket would be $100,000. Whereas if you go with a rehab loan as the first point of your BRRRR, your down payment is between 10% to 20%. So let's use the best case scenario as an example. 10% down, that's a $20,000 down. Plus the rehab is 100% finance. Therefore, that's $0 out of pocket. For the same deal, your total cash in out of pocket is $20,000. You see, that would be an $80,000 difference compared to going to route one. Now, even if we take the worst case scenario where you have to put 20% down, that would be $40,000. You would still be $0 out of pocket for the rehab, and the total would just be $40,000. Now, in either one of those scenarios, there are also extra costs like closing costs, right? Origination fees, etc. But you incur that in either way, in either of those scenarios, I might say. So Yeah, it's a big difference. Wait, there's more. On top of that, while you pay a lot less down, you can even finance the down payment and closing costs with what they call a gap funding. Gap funding is made to finance the down payment and the closing costs. So basically, you could get this to 100% financing, and then that money you keep on reinvesting it in other properties. The system. Well, here it is. First, you buy. That's the most important point. That's the point of entry. So, you buy the property with a rehab loan, what they call a fix and flip. And you can get only 10 to 20% due for a down payment. Second, you rehab the property. Now, the rehab is 100% finance, so you spent $0 out of pocket, right? Third, you rent the property. You rent it out, so it becomes income producing, an income producing asset, right? Then you refinance it with a long term mortgage, 30 years, very cheap, so that the property can make money. And this is when you pull out the cash that you initially put in at the point of entry, at the buy. So, and then you just repeat to your next property, and then to the next one, and then to the next one. Now, one thing, those two parts, rent and refinance, can be interchangeable. The place doesn't have to be rented yet for you to refinance it. Because if you decide to refinance it before the tenant gets in, it's okay. We'll do an appraisal and we'll appraise what is the market rate is for the rent, and this is where you will be able to get your refinance amount for. And you repeat, and that's it, guys. You see, the secret is how you finance the buy and rehab part. It's how you enter the deal, basically. That's the entire trick, the entire hack. And it's great. The takeaway: enter a deal with the lowest cash possible and get out with the most possible cash. That's the deal. And that is how you turn one pile of cash into a big pile of properties, a whole lot of properties. If you want help structuring a BRRRR, I put a link for you down below. It's a 2-minute link. Fill it out and you'll hear back from us. And if you like this video, you will love that one.